Hello and welcome to this Insurance Asset Risk Asia 2021 panel discussion titled Risk-Based Capital, Being Prepared for New Capital Requirements. My name is Andrew Tiatstra, Editor of Insurance Asia News, and I'm delighted to be joined by Sanjit Maini, Chief Financial and Operational Risk Officer at Prudential Asia, and Kai Se, Chief Risk Officer at QBE Insurance Asia. I would like to kick off the discussion by asking Sanjit about some of the progress surrounding the introduction of risk-based capital rules across Asia. Sanjit.
Hi, good morning, Andrew, and thank you. And thanks, Kai, for joining the panel discussion. Look, there's a number of changes that are happening in the industry around the space of capital regimes. We've recently had the introduction of RBC2 in Singapore, which went live in 2020 after many years of consultation. And we've got other regimes, for example, in Hong Kong, risk-based capital will be introduced, and the Hong Kong Insurance Authority is going through a consultation process at the moment with various quantitative impact studies being done. And the intention for Hong Kong is for a 2024 implementation of RBC. And if you look at other markets as well, where there have been introduction of risk-based capital regimes, there are upgrades happening constantly. So you've got the CROS in China, where there is an ongoing QIS process ongoing in China, where CROS phase 2 will be introduced, expected this year. And again, just briefly touching upon some other regimes, Thailand is also going through a period of consultation for a change, and so on. So the bigger markets like India, for example, is still on a Solvency I type regime. And the regulator there, the IRDAI, is also looking at introducing RBC over a period of time, although details haven't been released.
Right, and you touched on CROS in China. Can you go in a little bit more detail on what's happening in China?
Yeah, sure. Happy to do that, Andrew. So, in China, the CBIRC, the regulator, has been looking at, what changes should be made when they first introduced CROS a few years back. And what they did was in 2020, they've done 3 quantitative impact studies, which the industry participated in. And they're really fine-tuning some of the parameters, and most of the regimes are doing a similar scope, which is looking at various risk factors and refining them as they get more data, and sort of get feedback from the industry as well. One of the themes which is common, but also for CROS, which comes up, is on the quality of capital, which is kind of looking at a couple of ratios. So under CROS, you've got the comprehensive solvency ratio, but they're also introducing this concept of core solvency ratio, which is looking at a higher quality of capital. And for that quality of capital, of course, the threshold will be lower, but the bar in terms of qualifying capital is higher. So those are kind of some of the changes that CROS phase 2 will bring about.
And Kai, it's clearly a varying degrees of effectiveness across Asia. Each regulatory regime is at a different stage. From your perspective, Kai, from a QBE perspective, how are you dealing with all the different stages of the regulation in each country?
Yeah, I think similar to Sanjit, we're to some degree we're slightly different because we're a general insurance carrier. I think Sanjit is from a life insurance carrier. But I think many of the common themes from an RBC and its rollout and impact to overall insurance companies would be quite similar. But there are specific nuances that differ between life and general insurance companies, obviously. General insurance companies, the duration of our liability is obviously shorter to the duration of the assets and liabilities that typically go in the life insurance company. So we do have to reflect changes to our liability profile from the RBC impact that's rolled out in the 2 biggest markets for us, obviously Singapore and Hong Kong, and that's where the advances in RBC is being most impacted. So the changes will obviously drive in terms of our business mix and the growth of our business strategy, because the additional capital cost that comes with particular lines of business that we underwrite will be felt, and we will have to take a decision whether or not we want to remain in certain lines of businesses because the capital cost may be slightly more higher than where it was in the past, versus some other lines where they may become more advantageous for us to grow in. So I think those are the more immediate impact from an organizational perspective for a general insurance company. I think Sanjay touched upon a few other countries. One that I don't think that is generally on the radar for many people is actually Vietnam. We do have to actually have a presence in Vietnam, and from my understanding, the Ministry of Finance, which is I think the regulator in Vietnam, has actually started looking at, speaking with industry players in the market to assess, the viability of RBC and the impact of that to their organization at a very early stage. So I would say RBC is definitely coming to Asia, but obviously at different stages of development based on the maturity of those particular markets.
Thank you, Kai. And Sanjay, gradually there is some convergence, or with some standards across the region. Where do you see some of the convergences and some of the advantages here?
Yeah, I mean, look, as a broad theme, what's happening around capital regimes is a move towards an economic balance sheet, and that sort of is the underpinning philosophy behind many of these regimes. The other elements of convergence that are driving are IFRS 17, which is also an important influencing factor, but also the ICS regime, the International Capital Standards, being promulgated by the IAIS. So those are at the moment under a monitoring period. ICS will go live with public reporting in 2025. So we're still a few years out. But as those influences are coming through, the national supervisors are also kind of getting influenced by IAIS, by IFRS 17. A lot of that convergence is happening. But whilst there is convergence, there is also, I think, some important differences remain. So for example, even in things like valuation of assets, many countries have moved to a market value basis of valuing assets, but there remain important differences. There are markets where the valuation of assets is still based on an accounting basis. CROS is a good example where the valuation, in some cases in Japan as well. So you've got certain countries where the valuation of assets hasn't moved to market value basis. And the same thing applies on the liability side as well of the balance sheet. So it is in general a pretty consistent move towards a harmonized framework, but yet differences will remain. And as Kai was saying, I think, as countries are on different paths and, different points in time, I think that convergence might also take time over, for each market, because they're at different stages of market evolution, industry evolution as well.
And Kai, are you seeing any convergence on a global? I know you work for a global insurance company here, so are you working perhaps with other regions around the world to do?
Yeah, look, I mean, RBC obviously emanated from the US under the NAIC RBC regime, more than, I believe, maybe 20 years ago, in fact. So obviously it's come to Asia. It's taken some time. And obviously in Europe, under the UK regulator, under the PRA, they have a type of regulation which is quite, I think, to some degree similar to RBC in terms of some of the principles underlying, as well as in Australia, QBE's home organization and the regulator there, which is the APRA. So there are very similar type of regulatory in place in the more mature markets. And we are now starting to see that across Asia. I think the other thing that's interesting is, I think what RBC brings about is not just the kind of quantitative measures of assessing an organization, insurance company. I think it's actually part of a holistic risk management of the organization. Okay, so within Hong Kong, in addition to RBC, there's actually the ORSA implementation that's actually being brought forth within first half of this year. And across Asia, obviously, ORSA has been in place in Singapore. So within ORSA, the RBC bit of work is actually, I look at it as, the left hand and the right hand, right? It's a quantitative side of the ORSA bit. And obviously, ORSA has a qualitative aspect of looking at the entire risk of the organization. So I think all of that in total, we will likely see more ORSAs being rolled out as RBC gets rolled out and matured over the parts of Asia over probably the next 5 to 10 years. That would be my expectation going forward.
Thank you, Kai. And Sanjit, from a company point of view, specifically, how do you see a new robust regulatory framework such as RBC helping out the life insurers?
Yeah, look, I mean, Kai actually rightly touched upon some of the issues, including the fact that RBC is, I mean, there is a quantitative element which he talked about, but there is a 3-pillar approach to all of these regimes, which is the first pillar being the quantitative capital requirements. The second pillar is where there is this harmonized economic capital view or an own view of risks, and that's where ORSAs play an important role. Economic capital is increasingly going to play an important role in decision making. And then the last pillar being the public reporting element, which is kind of keeping the public informed, the wider stakeholder community informed, but also sort of using that as a feedback loop as well. So there is the 3-pillar approach. There is obviously embedding of ERM framework. Some of the other influences that are happening, clearly, I think there is increased need for, particularly for insurers like us, life insurers. Our liability durations are very long, and therefore appropriate incentives for us to hold assets for a long period of time. And so we saw when, things like, if you look at Solvency II, for example, one of the criticisms of Solvency II has been it's a 1-year value at risk, measure. And it's forcing insurers to think like a bank, whereas our liabilities aren't, 1-year liability. So there is some criticism of whether it's the right incentives under a pure market value, 1-year value at risk measure. And certain risks for life insurers aren't appropriate to be dealt with on a short-term basis. If the right incentives were there, that would incentivize appropriate investment behavior by insurers, and that can have a significant impact on the industry. So we are beginning to see some of those positive impacts. Singapore RBC2 is ahead of the curve in terms of the regimes that we've talked about in Asia, and therefore one of the things which we are working on, and I'm sure other insurers are as well, is this concept of a matching portfolio, where we're looking to hold assets for a long period of time, pretty much to maturity. And then we get a sort of a benefit of doing that as well. And just briefly touch upon RBC in Hong Kong as well. And that's where, again, the Hong Kong Insurance Authority is also looking at appropriate incentives for holding assets on a long-term basis, whether it's even equities or infrastructure assets like infrastructure debt or infrastructure equity. So those are very positive influencing factors to my mind.
Thanks, Sanjit. And Kai, from a P&C perspective, where do you see some of the benefits in the P&C market?
I think there's going to be a huge, significant impact to the general insurance industry. And I can give you a simple example. In Hong Kong, in particular, I think the number of general insurance companies versus the number of maybe life insurance company, which is probably a smaller cohort than the number of general insurance companies in the market. Historically, under Solvency I, which is the basis at which capital was calculated, it allowed a lot of smaller entities, right, to actually exist in the market, which would make the landscape from a competitive standpoint not as efficient by having too many players. By having RBC in place and then having a framework that assesses risk, properly, a lot of what I call the weaker players that should not be maybe in from a international capital regulation perspective, be competitive. They may find themselves, looking at, is this the market they want to remain in? Okay, I think RBC could potentially change the game in some markets. Okay, Hong Kong potentially could be one. Other markets where this gets developed, where the less efficient capital players gets consolidated, get bought out. So I think from an industry perspective, we might be able to see those sort of significant shifts in the market, which would ultimately could be beneficial for the market itself, right? Having too many players, sometimes it's actually not a good thing. Obviously having the right level of competition is good, but I think that's would be one of the impacts that I could see forthcoming from having RBC put in place. across different parts of Asia.
Thank you, Kai. And looking at a kind of wider, more systematic approach to the market, Sanjit, what other kind of regulatory themes are you seeing in the industry at the moment? Maybe in Hong Kong.
Mm-hmm. Yeah, look, Andrew, one of the important elements of change that we've seen is the introduction of a group-wide supervisory regime by the Hong Kong Insurance Authority. So the Insurance Authority in the past has obviously been the supervisor for solo entities in Hong Kong, but with legislative changes that were done last year, the Hong Kong Insurance Authority now has the legislative powers to supervise entities on a group-wide basis. So my company Prudential is one of the 3 designated group-wide entities under the GWS framework by Hong Kong Insurance Authority. So we are going to be managed, supervised by the Hong Kong Insurance Authority on a group-wide basis, and that brings different elements of focus for them and also for our interactions. We're very used to operating under that framework within the supervisory college with a lead regulator. In the past, we had the PRA. But now we've been working very closely with the IA, and that's, I mean, one of the aspects which I also wanted to bring about within GWS, because we were talking about convergence a bit earlier, is the fact that under Pillar 1 for GWS, the Hong Kong Insurance Authority has chosen a method called the LCSM method for aggregating capital, which is essentially, in sort of simple terms, respecting the local statutory capital requirements of each jurisdiction. So when they aggregate capital for an entity like ours, essentially it's really respecting the existing local capital requirements of each jurisdiction and then aggregating them. So that's in some ways, respecting local stat regimes. It will drive certain behavior in terms of, cash and capital at the local entity are now aligned. Because that's how the capital is being aggregated for the group. So yeah, that'll play out. The other element which we are seeing is this whole focus on quality of capital, and that's evidenced very much in Singapore in the MAS RBC2 regime, where there is a concept of a tier 1 ratio in addition to a sort of solvency ratio or a capital adequacy ratio. And again, possibly tier 1 ratios might drive cash more than solvency, but we'll have to see. Each entity might have to do their own calculations as to which one bites under different conditions. But we are seeing these, a couple of elements within a capital regime, but aspects which might have wider impact in terms of the company's, operations and ability to remit dividends as well.
Sanjay, just to confirm, the group-wide supervisory framework, GWS, that came in Hong Kong, I believe, at the end of March?
Yes, that's correct. So that's gone live. It's actually being implemented in Q2 formally for the 3 entities that are designated. And there is a period of transition for certain aspects of that, which each company would have agreed with the Hong Kong Insurance Authority. But yeah, that's a very positive step from our perspective that's gone live.
And Kai, any other regulations that you would like to highlight that may chime with RBC or kind of that may help or aid it?
Yeah, look, I think there's a vast of different regulations that we're seeing across different parts of the globe, right? I think some regulators are ahead of some of the, I think, social related issues. I think one that's clearly in the spotlight, I think in the press a lot of times, is ESG, right? Environmental sustainability, and that type of green related risk. And that talks quite broadly, okay? It's not just environmental. I mean, there are other things underneath it with respect to human trafficking, okay, as well. And separately to that, conduct risk for organizations. So from our perspective, ESG is one of the more, I guess, important regulatory changes that we're starting to see. Our home regulator, as well as the in Australia, as well as the PRA, have a strong focus on that, and we're starting to see that across Asia from both Singapore regulator under the MAS, as well as the Hong Kong regulator, right? there's a lot more discussion, there's a lot more socialization between the regulators and the insurers themselves, in particular on these particular matters. I mean, they've raised questions and asked specifically, what are general insurance companies doing with respect to ESG risk? What is our 5-year plan? Are we looking to continue to put our money into clean energy versus dirty coal-related or pollutant type industries, both from a liability and asset perspective, right? So that from a liability perspective for a general insurance company, we potentially could be some of the risks that we could potentially be still having on board that we're looking to remove over time is, should we be ensuring the directors and officers of a dirty coal company? I mean, we write, D&O insurance cover, okay? Should we be, looking at those specific industries, and should we even be participating in those industries, okay? So there's a number of those particular, I think, regulatory changes, and I could actually foresee in the future that if RBC advances to the point where, let's say, they start thinking about ESG considerations within the RBC framework, would it be surprising to think that RBC would then have a separate, maybe capital charge related to ESG related risk, right? I mean, I could foresee that being something that the regulators themselves, being socially and economically sensitive, they may want to put that into the next iteration of RBC. Now, obviously, I don't want to tell the regulators now that's something they want to think about, but I could foresee that being something that materialize within the next 5 to 10 years, the next evolution of RBC.
So when you look at ESG, are you looking at that from a country by country perspective, or are you looking at it from a group perspective?
We start off at a group lens, and then we look at it. It is a holistic view from our organization. We actually have made commitments to our shareholders and to the public in Australia because we are a listed Australian Stock Exchange traded entity. So we have made public commitments, and it's both with respect to, again, the asset portfolio, the liability portfolio, and obviously ESG with respect to climate risk in its entirety has an impact to the performance of a general insurance company, right? The number of CATs, the number of windstorms and earthquakes, that actually impacts our balance sheet as well, obviously, from a natural catastrophe perspective. So there's an element we can control, which is who we put our money, where do we put our money, and who do we underwrite. And there's obviously an element that we can't control, which is the nat cat piece.
Thanks, Kai. Sanjit, would you like to add anything?
Yeah, I mean, look, I think the ESG point is well made. I mean, that there is clearly a sort of an impetus towards recognizing some of the ESG risks. For us as a life insurer and an asset manager, so we've got both an asset owner and an asset manager perspective. One of the big things which we've been looking at is obviously on the investment portfolios. What should be our stance? And of course, we're watching the space very carefully. Again, it's a group-wide approach for us, very much looking at what we should be doing. So in that space, I think the GI space is where the liabilities get directly impacted a lot more. Yeah. For us, it's more on the asset side of the balance sheet, I would say. But there are, as Kai rightly pointed out, wider considerations of ESG. The other element which is also coming up as an influencing factor is conduct risk, which I'm sure Kai is feeling it in his organization as well. The insurance authority in Hong Kong, in its own RBC regime, again in Pillar 2, has placed increased focus on conduct risk as well, and we're seeing that across the region, and not just in Hong Kong, in Singapore as well, with the senior managers regime. So there is a great deal of focus on conduct risk, which is very appropriate as well.
Absolutely. Well, thank you both for your time for this panel discussion. We really appreciate it. Thank you to our panelists, Sanjit Mayani, Chief Financial and Operational Risk Officer at Prudential Asia, and to Kai Say, Chief Risk Officer at QBE Insurance Asia. Thank you very much for your time.
Thank you, Andrew. Thank you, Sanjit.